From short squeeze to margin call, we're breaking down key terms you need to know in the world of shorting stocks. This video is perfect for the beginner looking to understand the common terms used in the investment strategy where you profit from falling stock prices. What is short selling? Short selling might sound complex, but it's actually a straightforward concept in the world of investing. It's a strategy used by investors who believe that the price of a stock is going to go down. Instead of buying low and selling high, as in traditional investing, short selling flips this approach on its head. You sell high and aim to buy low. Margin account. A margin account is a brokerage account in which the broker lends the investor cash to purchase stocks or other financial products. This loan increases the buying power, but also increases potential losses, including in short selling. To engage in short selling, an investor must have a margin account, as the practice involves borrowing stock. Margin call. A margin call occurs when the value of an investor's margin account, a type of account where stocks are bought with borrowed money, falls below the broker's required amount. The investor must either add more funds to the account or sell assets to maintain the minimum margin. If you are short selling and the stock price rises instead of falling, you may face a margin call to cover potential losses. Short position. A short position is created when an investor sells borrowed stocks in anticipation that the stock price will fall. The investor aims to buy these stocks back at a lower price. If an investor borrows and sells 100 shares of a company, they have a short position in those 100 shares. Cover. To cover in short selling means to buy back the borrowed stocks to close a short position, ideally at a lower price. If you sold borrowed shares at $50 and the stock price drops to $40, you might buy back the shares at $40 to cover your short position and make a profit. Short squeeze. A short squeeze happens when a stock with a high level of short interest, many short positions, suddenly increases in price, forcing short sellers to buy back the stock to close their positions, which further drives up the stock price. If a heavily shorted stock starts to rise rapidly, short sellers rush to cover their positions, leading to a short squeeze. Hedge. In investing, a hedge is a strategy used to offset potential losses or gains in one position by taking an opposite position. An investor might short sell a sector they expect to decline as a hedge against their long positions in the same sector. Stop-loss order. A stop-loss order is a trading order placed to limit losses if a stock price moves against the investor's position. For short sellers, it means buying back the stock if its price rises to a certain level. A short seller might place a stop-loss order at 10% above their selling price to mitigate potential losses. Short interest. Short interest is the total number of shares of a particular stock that have been sold short but have not yet been covered or closed out. High short interest can indicate that many investors are betting that the stock price will decline. Short interest ratio, SIR. The short interest ratio, often called the days to cover ratio, measures the number of days it would take for all short sellers to cover their positions based on the recent average daily volume of the stock. A high SIR indicates a potentially higher risk for a short squeeze, as it would take longer for all short sellers to exit their positions. Short covering. Short covering refers to the process of buying back borrowed securities in order to close out an open short position. It often occurs when short sellers decide to take profits or prevent further losses. If a short seller anticipates that the stock price will no longer decline, they may engage in short covering to lock in their profits or cut losses. Leverage. Leverage in investing refers to using borrowed money or financial instruments to increase the potential return of an investment. Short selling often involves leverage, as the investor is using borrowed shares. An investor might use leverage in short selling to amplify their potential gains, but this also increases the risk of significant losses. Put option. A put option is a financial contract that gives the holder the right, but not the obligation, to sell a specific amount of an underlying asset at a set price within a specific time frame. It's a way to bet on a stock's decline without short selling. If an investor believes a stock's price will fall, they might buy a put option as an alternative to short selling.